Let's cut through the noise straight away. Transocean agreeing to acquire Valaris isn't just another headline, it's a tectonic shift in the offshore drilling world. For decades, both companies have been rivals, giants in offshore oil field services, owning fleets of rigs that drill in some of the toughest environments on Earth, from deepwater trenches off Brazil to North Sea storms. Now they're joining forces in a $5.8 billion all-stock deal, creating what analysts are calling one of the most powerful offshore drilling players on the planet. That's not small potatoes. It's the consolidation of scale in an industry that's been squeezed by client cutbacks, capital discipline, and rising technological expectations. According to One, Transocean will acquire Valaris in an all-stock transaction valued at roughly $5.8 billion. This merger isn't being done for bragging rights. It's a calculated play to dominate deep water, harsh environment, and even shallow water drilling markets by creating a combined fleet of 73 rigs, a scale unmatched in the sector. That sheer capacity gives the new company negotiating leverage, broader geographic reach, and a deeper backlog of contracted work. That's huge in an industry where drilling contracts can be multi-year, multi-hundred million dollar commitments. One, the immediate market reaction tells you everything you need to know. Valaris shares exploded on the news, up double-digit percentages in pre-market trading, while Transocean stock dipped. Why? Investors in the smaller firm see upside and premium value. Transocean shareholders are wary of integration risks and execution complexity. That's the raw reality of big deals. If you're not uncomfortable, you're not thinking big enough. 2, this deal signals something even bigger. Rig count, technological capability, and financial muscle are everything when clients, big oil producers, tighten belts and demand efficient drilling operations. In a world where every dollar counts and investors scream for return, scale equals survival.
The strategic logic, what both sides really stand to gain.
All right, let's cut the bullshit. Most M&A chatter you see online is vague corporate jargon. Synergies, efficiencies, blah, blah. But here's the real strategic playbook behind this merger. First, dive into why Transocean even wanted this deal. Transocean is already one of the largest offshore drilling contractors globally, with decades of history and a massive portfolio of rigs deployed across major oil basins worldwide. But size alone doesn't win contracts. Specialization and fleet quality do. Valaris, too, isn't a weak player. It's historically one of the biggest independent offshore drillers with experience in ultra-deepwater and volatile environments. Bringing these two fleets together means eliminating redundancy, concentrating elite rigs, and forming a fleet that's not just bigger, technically superior and more adaptable. According to press releases around the deal, the combined company will boast an estimated enterprise value of about $17 billion, a number that matters. Enterprise value isn't just market cap, it's perceived earning power plus debt minus cash, meaning the market sees serious revenue potential if this goes right. The combined backlog, future contracted work, is estimated around $10 billion, meaning years of revenue visibility, which big-ticket customers like BP, Petrobras, Total Energies, and others love to see. But the strategic logic goes deeper than just numbers. In a landscape where oil and gas companies are under pressure from market forces, geopolitical risk, and energy transition narratives, they don't want fragmentation. They want reliability. A single, larger drilling contractor with broad geographic reach means more efficient utilization of rigs, spread of fixed costs over a larger base, stronger pricing discipline due to fewer competitors, better ability to meet complex offshore contracts without costly third-party subcontracting, more efficient utilization of rigs, spread of fixed costs over a larger base, stronger pricing discipline due to fewer competitors, better ability to meet complex offshore contracts without costly third-party subcontracting. And let's be honest, there's another real driver here: cost synergies. Companies don't pay multi-billion dollars just to become slightly bigger. They pay for over $200 million in expected cost synergies. That's not corporate fluff. That's real money that can be returned to investors or reinvested in technology. So if you strip away the PR, this deal is a smarter, leaner, consolidated war machine in a global offshore drilling battle for contracts, profitability, and long-term relevance. Now listen, this is where the rubber meets the road. Money talks louder than press releases. When the market prices Transocean stock down and Valaris' stock up on dawn of trading after the deal news, that's the market whispering the real playbook. According to multiple trading reports, Valaris shares were up significantly in pre-market trading, double-digit gains, while Transocean stock dipped. That tells you something simple. Investors are pricing in risk for the buyer and premium value for the seller. Valaris shareholders are getting a near-term valuation boost because they are being bought out at a premium. Transocean holders are spooked by integration risk, dead road, execution risk, and the challenge of blending massive operations without friction. Let's talk numbers for a second, because sugarcoating this is not allowed. Valaris shareholders are set to receive 15.235 shares of Transocean stock for each Valaris share they hold, and that represents a 31.6% premium to Valaris's last closing price. Premiums like this don't come cheap. Transocean is effectively paying up for talent, assets, backlog, and brand reputation. Pro forma, Transocean will own approximately 53% of the combined company, with Valaris shareholders owning 47%. That means Transocean is still the larger shareholder, but the ownership split is almost equal. That's not a one-sided acquisition. It's a near marriage. Combined enterprise value sits close to $17 billion, with a market cap in the ballpark of $12+ billion, meaning the deal is not just about asset scale, but market perception of future revenue streams. But here's the brutal, honest takeaway. This is not guaranteed to make Transocean rich overnight. Integration risk is real. Blending two massive fleets, operational systems, cultures, contracts, and client expectations. Any misstep and that $200 million in expected synergies could evaporate. Investors know this. That's why Transocean's share price softened. Valaris shareholders, on the other hand, got certainty, immediate value premium, and exposure to a bigger entity with broader reach. That's why their stock shot up. Markets hate uncertainty. The deal brings clarity to Valaris ownership, less to Transocean's near-future execution. Now let's zoom out and look at the bigger chessboard, the entire offshore drilling industry. This deal isn't a fluke. It's part of a wave of consolidation as offshore service providers brace for shifting realities. Slower new well expenditures by energy companies, emphasis on returns instead of growth, and reallocation of capital towards renewables and low-carbon ventures. When clients tighten the purse strings, suppliers either scale or die. This isn't the first time the rig market has consolidated. In recent years, we saw mergers like Noble and Diamond Offshore, and now this even bigger tie-up between Transocean and Valaris. Industry analysts have been signaling for consolidation pressure for months before this, because large oil producers increasingly want fewer, more reliable drilling partners with deep financial backing and specialized fleets. The combined fleet of 73 rigs, including 33 ultra-deepwater drillships, 9 semi-submersibles, and 31 modern jackups, gives the new company technical depth few rivals can match. Any offshore project worth hundreds of millions is looking for reliability, capability, and flexibility, and a single contractor that can deliver all three is exactly what customers want. But let's be real, this is also a battle for survival. Smaller players without scale risk being squeezed out. Bigger players without strong balance sheets risk losing pricing power. So far, Transocean and Valaris are betting that size, fleet mix, and backlog visibility will keep them relevant, even as energy giants shift focus. If rigs are fewer but more specialized, the new company could extract pricing power and operational efficiency others can't. Here's the stark truth. The offshore drilling market isn't dead. It's evolving. Demand for offshore oil and gas isn't disappearing overnight, but capital allocation is tightening. Investors want companies that can generate free cash flow, not just burn capital in asset operations. This merged entity has a better shot at meeting those expectations if they manage execution without blowing up costs or timelines. In short, this deal is a statement. Offshore drilling is consolidating around.
Let me tell you something most people don't understand about industries like offshore drilling. The real money isn't in drilling oil, it's in controlling who gets to drill. This Transocean-Valaris merger is about power, not just profits. When an industry consolidates, pricing power quietly shifts. Fewer players mean fewer bids. Fewer bids mean contractors stop racing to the bottom, and that's exactly what Transocean is aiming for. According to Reuters, the offshore drilling market has suffered for years due to oversupply of rigs, weak day rates, and aggressive competition. This merger directly attacks that problem by reducing competition at the top end of the market. Think like a chess player, not a headline reader. Oil majors like Shell, BP, ExxonMobil, Petrobras, they don't want 10 small, fragile contractors begging for contracts. They want 2 or 3 monsters who can execute billion-dollar projects without collapsing midway. When Transocean absorbs Valaris, it becomes a gatekeeper. If you want ultra-deep water capability, harsh environment rigs, or global deployment, you talk to them. This changes pricing psychology. Instead of asking, how low can you go, clients start asking, who can actually deliver? That's how margins quietly rise without announcing price hikes. According to industry analysts cited by Reuters, offshore day rates have already been recovering due to tight supply of high-spec rigs. This deal accelerates that trend. Now, here's the uncomfortable truth. Pricing power is invisible until it's unstoppable. By the time customers complain, the structure is already locked in. Transocean knows this. Valaris knew this. That's why they didn't wait for desperation. They merged while both still had leverage. This isn't just a company growing bigger. This is a company saying, we decide the rules now. And in capitalism, whoever sets the rules gets rich.
Now, let's talk about the ugly part, debt. Because real businessmen don't ignore risk, they manage it. Transocean has always carried heavy debt, a legacy of years of expansion, downturns, and restructuring cycles. According to Reuters, offshore drillers historically borrowed aggressively during boom cycles and paid the price when oil prices collapsed. This merger doesn't magically erase that history. Yes, the deal is all stock, meaning Transocean isn't paying cash up front, but debt doesn't disappear just because you merge. It concentrates. The combined entity inherits obligations, maintenance costs, stacking expenses, and future capital requirements. Here's the danger. If oil prices fall sharply, or if offshore investment slows faster than expected due to energy transition pressure, a heavily leveraged giant becomes a slow-moving target. Smaller companies can pivot or die quickly. Giants bleed slowly. According to Reuters, analysts have flagged that while cost synergies of over $200 million annually are projected, those savings must materialize fast to justify the risk. Integration delays, labor inefficiencies, or contract renegotiations could wipe out projected gains. This is where discipline matters. The new Transocean cannot afford ego. It must retire inefficient rigs aggressively, avoid vanity capex, focus on free cash flow, not fleet size bragging. Retire inefficient rigs aggressively, avoid vanity capex, focus on free cash flow, not fleet size bragging. Here's a hard truth I want you to remember in your own business journey. Debt is a tool, but only when cash flow obeys you. If cash flow starts controlling decisions, the business owns you. This merger is powerful, but it's also a test of leadership maturity. If management executes cleanly, they win big. If not, the market will punish them brutally and fast.
You've heard the noise. Renewables, EVs, net zero, green energy. Good. Necessary. But here's the reality most headlines won't say clearly. The world still runs on oil and gas, and it will for decades. According to Reuters and multiple energy outlooks, offshore oil production remains one of the most cost-efficient long-term sources of supply once infrastructure is in place. Deepwater projects have long lifespans, stable output, and lower decline rates than shale. That's exactly why offshore drilling hasn't vanished. It's strategically protected. Governments want energy security. Oil majors want predictable production. Offshore fields provide both. Transocean understands this better than anyone. This merger isn't a bet against renewables. It's a bet that oil demand declines slowly, not suddenly. And during that slow decline, the strongest players will absorb the profits while weaker ones exit. According to Reuters, many oil companies are prioritizing fewer but larger offshore projects, meaning less volume, higher quality. That favors large contractors with top-tier rigs, not fragmented operators. This is an important lesson for you personally. Don't chase trends blindly. Chase what survives cycles. Offshore drilling survived crashes in 2014, 2020, and now energy transition pressure because it adapts. This merger is adaptation in real time.
Tail investors argue, smart money waits. Right now, institutions are asking 3 questions. Will synergies arrive on schedule? Will oil majors keep offshore spending stable? Will management prioritize cash flow over empire building? Will synergies arrive on schedule? Will oil majors keep offshore spending stable? Will management prioritize cash flow over empire building? According to Reuters, hedge funds and long-term investors are cautiously optimistic, but not euphoric. That's good. Euphoria kills discipline. If Transocean proves it can execute, retire debt, lock contracts, stabilize margins, this merged entity becomes a cash-generating machine in a capital-scarce world. If not, it becomes another cautionary tale of too big, too slow. Markets don't care about effort. They care about results.
Let me finish with this. And listen carefully. This merger teaches one brutal rule of money. When industries mature, winners consolidate, losers disappear. Transocean didn't merge because it was weak. Valaris didn't sell because it failed. They merged because timing, scale, and leverage aligned. In your life, your business, your brand, the same rule applies. Build skills, build leverage, build assets,